Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are a quarter down in 2025.
Oh my goodness.
And if I had any hair left to lose, I would have lost it.
It has been a pretty crazy start.
For people who are watching on YouTube, they might say that you are also losing your hair, but rather than from the top down, you're losing your hair from the bottom up.
And it's also voluntarily.
Okay, we'll rub that in. I mean, yes. Bryce has gone
Slick haircut.
I called it the Bailey Fritsch fade.
Slightly different, but along those lines.
Yeah.
I'm loving it.
It does look pretty good.
It's just going to grow back really quickly.
It makes you look younger.
I'm going to have to go from my 5-week rotation to probably 3.5 week.
You get a haircut every 5 weeks?
Yeah.
What does a haircut set you back these days?
$60.
Jeez.
Yeah. Anyway.
Compared to me shaving my head in the bathroom. Well, look, that is a good segue into what we're talking about today, because we're going to talk about prices and how much they've changed as we enter a cost of living election in Australia. We're also going to talk about how much market prices have changed in the first quarter for this year. We're going to sort of take a breath and say, where are we 3 months in for the quarter? We're going to then turn to you again.
Yeah.
And you've recently got personal financial advice.
I have.
And we're actually going to get your advisor in the studio and we're going to chat about some of the recommendations. So
put him in the hot seat.
I'm excited to get some free advice sitting next to you.
True.
But before then, I think we want to remind everyone about our YouTube channels.
That's right, Ren. We have split our YouTube channel to align it with our podcast, so there's no more confusion. On one of them, you'll now find Equity Mates Investing Podcast in its full length, which is what you're listening to now.
Yeah, or if you're on YouTube, what you're watching now.
What you're watching right now. We also then have Get Started Investing out on its own. You'll find all of the foundational episodes that we do there for Get Started Investing. And then we have Equity Mates Clips, where we take the highlights and the best bits and clip them all up, and you'll find them on that YouTube page. Mr. Beat Up, you name it. They're all on there. Pimp My Portfolio, Ask an Advisor. All of the segments that we do clipped up. So make sure you're subscribed to all of them, but no more confusion.
Yeah, all right. With that, let's get to the news.
News and markets.
All right, so as we said, we're a quarter in. Let's take a breath and just reflect on how we're going and what we can learn. So let's start here in Australia. We've had the worst first quarter since COVID. Which wasn't that long ago, really.
2020, well, in 5 years.
5 years, yeah. The ASX 200 down 4.4%.
Yeah. Good news, Ren, though, we're not the worst.
That is the bar that I'm constantly trying to jump
We're not
over.
the worst, yeah. So the Nikkei 225 or 225, which is the Japanese exchange, is down 9.4% for the year.
Yeah, tough.
It had a stellar year last year, though.
Yeah, the S&P 500, where Australia goes, America follows.
Yeah.
When America sneezes, Australia catches a cold. All those sayings. We have copied America once again. The S&P 500 also down 4.4%. So the same as the ASX 200. But the story is worse if you zoom in on America's tech sector, and particularly some of the big tech players. The NASDAQ 100 down 8.1%.
Yeah, certainly feeling it in my portfolio. To get through a few of the others, the Nifty 50 over in India, it's relatively flat, down just under 1%. But this is where it changes, Ren. The FTSE 100 over in Europe, I should say, is up 3.9%.
Yeah. Well, that's the UK, to be clear.
Yes, the UK, yeah. Stocks 600, that's Europe, is up 4.6%. The CSI 300, that's China, is up 1.8%. But the star performer for the last quarter is the Hang Seng, is up 17.8%. That's in Hong Kong.
Yeah, and so you'll find a lot of the high-flying Chinese tech companies will be listed in Hong Kong, not in mainland China. So they're in the Hang Seng, not in the CSI 300.
Yeah.
So let's take a breath. That's a quick whip around the world. The traditionally slow-growing, boring laggards of the stock market world, the UK, mainland Europe, no one wanted to be there. They're doing well. China, which since Evergrande started collapsing a few years ago, has been in this slow-moving, property crisis, which has bled into a consumer confidence crisis and a full-blown economic crisis. Well, China and Hong Kong has been the star performer.
Yeah.
And meanwhile, where every investor has herded to over the last 5 or 10 years, US and particularly US tech, more recently India has been quite popular. They're all down. So what's the takeaway?
The takeaway is to be globally diversified.
Yes.
Yeah. So I think you'd be finding if you had gone all in on US tech, you'd certainly be feeling it. But if you'd taken that traditional core approach of being diversified across geographies at low cost, you would certainly be happy with your decision to do that.
And the great news is with ETFs these days, you can be globally diversified from whatever country you're investing in. And there are all world ETFs. In Australia, you have DHHF, VDAL, VDHG, some of the more popular tickers. And they give you global diversification. The way that Bryce and I approach it is we like getting region-specific ETFs. So we have a Europe ETF and an Asia ETF and a US ETF, which allows us to keep our weightings even, which is a drag when the US is just ripping and you just want to be overweight the US. But in a time like this, when the US is falling and Europe's doing well and Asia is doing better, then that equal weighting approach has worked well for us in our core.
But it's not only geographies, Ren, that are performing differently at the moment. We're also seeing asset classes a little bit, performing differently as well. Bitcoin, it's suffering a bit at the moment.
Yeah.
Down 11%, 11.5% for the quarter. We're going to be banging through 125,000 USD.
We still might.
I'm not saying it, but yeah, Bitcoin down. On the other side, though, gold continues to rip. It's up 15, just shy of 16% for the quarter in AUD.
So be globally diversified and be diversified across asset classes. The good news is it's never been easier to do both. But Bryce, let's get to the other big news story that's dominating headlines in Australia, and that is the Australian election. The starter's gun has been fired. We're in a shadow election really since the start of the year. No one knew when it was happening. We now know the 3rd of May, magic round for the rugby league. So if you're going up to Queensland, make sure you vote.
We're on a bucks as well. We need to vote.
Yes, we are on a bucks, and it's also my sister's 30th.
Oh, wow. Big weekend.
Yeah. But look, I think it's clear it's going to be a cost of living election.
Yep.
I think everything is really focused on that. You know, Dutton has come out and said he's going to break up the supermarkets.
Yeah.
Albanese in the first weekend of the campaign, his first announcement was a price gouging commission.
Yeah.
And he told supermarkets to stop taking the piss.
Yeah, which I thought was, I liked Coles' response, which was, guys, you've had that many royal commissions into us. Go and sort the structural issues here. Energy prices.
Yeah.
Come on.
Yeah. The ACCC said there was no systematic price gouging.
Yeah.
And we're going to have a price gouging commission.
Exactly.
Yeah, But the reason that supermarkets are such a salient issue and the reason that it's going to be a cost of living election is because we're all feeling the increase in prices.
Yes.
And we've got some data that looks at price changes over the last 3 years.
Yeah.
Because, you know, while we measure inflation year on year, 3% this year, 7% at its peak, inflation is a cumulative thing.
Yes.
Prices rarely go back down.
No.
And some of these price changes are pretty wild.
Yeah, well, we've got, let's start with the top 5 biggest price changes in the last 3 years in the categories. So international holiday travel and accommodation is up 44.5% in the last 3 years. Now, a lot of that would be driven by the Aussie dollar, the weak Aussie dollar.
Some of that would be driven by the weak Aussie dollar.
Some of it, but no doubt the Aperols in Italy are getting very expensive.
Oh, no, it's also just like Qantas has been taking the piss a little bit.
Yes, true, yeah.
So to illustrate how it's not all just the Aussie dollar, there's a separate category, domestic holiday travel and accommodation, and that is up 20% in the past 3 years.
Yeah.
So,
yeah. But number 2, though, the barometer of inflation is eggs.
Eggs.
Up 35.5%. That's just not here in Australia, though. Globally, there's an egg crisis.
Well, yeah, there's a bird flu epidemic.
Just wiping out eggs.
More than 200 million chickens killed globally.
Yeah,
so
yeah.
we can understand that one.
Insurance was number 3, up 35.5% as well.
Which is why, if you tie this back to the election, why Peter Dutton, potentially on the fly, said he was also going to break up insurance companies.
Yes, yeah.
I don't know if breaking up insurance companies and having smaller insurance pools does actually lower premiums, but that's a separate conversation.
Number 4 is oils and fats. So a lot of the inputs that go into our food, that's up 34.7%.
And if anyone's seen the price of olive oil in the shops, that's probably all captured in that number.
And remaining in the 30s is gas and other household fuels, 31.1%. So that's the top 5, all price rises of over 30% in the past 3 years.
Some other notable ones: tobacco, that's hitting you hard.
No, couldn't care less.
27.5%. Obviously, a lot of that is the tobacco excise.
Yeah.
And the story running around at the moment is that the tobacco excise has gone up so quickly and by so much that the black market for cigarettes is really starting to thrive again.
Yeah.
Bread up 24.5%. Cakes and biscuits up 21.8%. And then we get to one of the biggest costs of the election. It's not top of the charts, but it's certainly top of mind. New dwelling purchases by owner-occupiers up 20.5%.
Yeah, that's where it hits. It's good to zoom out and see what, you can somehow think that 2.5% here and there doesn't really add up, but it certainly does. I wanted to have a look at the flip side though,
I was
Ren.
going to do the same,
What categories have actually fallen in price? And there are a few. So footwear for women is down 1%.
Okay.
Automotive fuel down 1.1%. Household textiles down 1.9%. And then meat. So lamb and goat, beef and veal, all down over 2%.
That's surprising.
Same, yeah. I am surprised with that. Woolies and Coles should be standing up and screaming from the rooftops.
Yeah.
And then childcare down 5.3%. Electricity is down 11%, but I imagine that's because of the huge subsidies that are coming through from government.
Well, that'll be the same with childcare as well. So they've been 2 focus points for Anthony Albanese for leading up to this election. I watched his interview on Insiders on Sunday, and childcare, electricity subsidies. There's a lot of demand side liberalism. I think I said on an earlier episode how there's a lot of just like subsidizing the cost of things rather than trying to work on increasing the supply of things, and there are 2 areas where that's happening.
Yeah. Nice. So we're going to keep an eye on, I guess we would imagine there's going to be more cost of living policies come out over the next few weeks, or announcements. There's already been some, but certainly keep an eye on what's coming in the election campaign.
Yeah, I think the best place to keep up to date with the news, particularly with your business or investor hat on, is our daily news email hitting your inbox at 6 a.m. every morning, a dot point summary of the news and the headlines you need to know from around the world. To sign up to that, head to the link in the YouTube description or the podcast show notes. But Bryce, let's take a quick break here, because on the other side, we're going to be joined by your financial advisor, Matt Ingram from Northhaven, and we're going to go through some of the recommendations he's made, and we're going to get specific. We're going to hear about what's going on under the hood with Bryce Lesky's finances.
Yeah, stay tuned. Welcome back to Equity Mates. Ren, you teased it before the break that we're going to go under the hood of some of my personal finances, because I've gone through the process of getting personal financial advice. And it is my pleasure to welcome to Equity Mates for the very first time, Matt Ingram from Northhaven Financial Management. Matt, welcome.
Yeah, thank you. Thanks so much for having me.
Now, Matt, when you started giving Bryce advice, did he tell you that part of the job was to come on the podcast?
No, not at all.
This sprung on you after you were already working with him?
Yeah, I actually kind of always imagined, there'd be a decent window of time where it's time to prepare and everything. Yeah, I spoke to Bryce, I think last Thursday or Friday. He's like, hey, come on Tuesday. Yeah. I'm like, cool, let's do it. Yeah. Nice.
Yeah. Well, no, we're excited about this because I haven't gone through the process of getting personal advice. Bryce gets to be the guinea pig, and we get to hear how it has all gone. So I guess, where do you want to start?
Well, I think we should start firstly by saying that Matt is now officially part of the Equity Mates referral or advice program. We have been inundated with requests from you guys, the Equity Mates community, to be put in touch with financial advisors. And so after having gone through the process with Matt, you are now part of that. So if you do go to equitymates.com/advice and fill in the form and get put in touch with Matt, this is why, because he's now part of that sort of trusted network. Sort of put some context to that, Matt. Who are the type of clients that you're looking after at Northhaven?
Yeah, so I'll start with Northhaven more broadly. So we've been around for 30 odd years now. And we have 5 advisors there. 4 of us own the business, and then we've recently brought on another advisor. The more senior advisors typically work in the high net worth space. And then we've got an advisor there who deals with big life transitions, things like divorce. And then me, I work with the wealth accumulators. So typically people in their anywhere from their late 20s through their 30s and 40s, really in that wealth building stage. So that's who I specialize in, and mostly my clients. That being said, I have a client who just turned 91.
Oh, wow.
So sort of both ends. And so, it's very different, a lot of variety working with older clients and younger clients, but we take that whole life approach, and that's what we're built on. Any client that comes to us, we have someone that can help.
Nice. So I guess to put some context to my experience, I went to Matt and with Harriet, so we went through this together. And the first thing you do is you have to put down your big lofty goals.
Okay.
So I said
What
to
were your
Matt,
goals?
we want to have the mortgage paid off by mid-40s.
Yes, that was one of them. Bryce gave me 17.
No way.
So
Did I? Was it
So
17?
I counted yesterday.
Oh,
So we
hang on, one of them was a dog, and that was Harriet.
Yeah, we took that one off.
Yeah, okay.
I think I-
surely you can do that now. Yeah.
I broke Harriet's heart a little bit when Bryce gave me the little down though. He said, "Hey, don't worry about the dog." So I said, "All right, we'll leave that out for now."
If we keep that comment in the podcast, Bryce is going to get in trouble. So.
I think I've told Harriet. She's aware.
Yeah, she's aware.
Okay, so 17 goals. So number 1 was pay off the mortgage by your mid-40s. For context, you're in your late 30s now.
So really 10 to 12 years. What'd you say? I wasn't even listening. Late 30s.
Yeah.
No. I've got a decade ahead of me.
So 12 years.
So,
10
10
you
to
basically want
12
to
years.
cut your mortgage repayment time in half.
Yeah. Because I feel like if we could do that.
He hasn't made it easy for you, has he?
No. Well, Bryce was also realistic in a lot of ways with those goals. So being specific with your goals is actually really helpful. I sometimes have clients that just say, I want to retire comfortably. It's like, okay, what does that even mean for you? That's so different for everyone. Bryce had short-term, medium, and long-term goals.
He's very organised.
Yeah, but it was really helpful because as I put together a strategy, I could say like, yeah, we can achieve this goal. This is realistic. Maybe this one needs a little bit of tweaking, a little bit of changing.
Yeah.
So it was really helpful, and I think the strategy we put together is likely to achieve a lot of those goals. Obviously, things are dependent on market returns and so forth, but the structure's in place to be able to achieve the goals.
So people are obviously wondering, don't tell us all 17, but give us some of the lofty goals.
Well, I mean, the long-term goals that Matt really didn't address, fair enough, because they were so long-term. One was buy a farm.
Okay.
Be in a position where I could buy a rural property.
Yeah, okay.
Those sort of longer-term, just nice to, this would be the ultimate scenario.
Yeah.
But the midterm ones were be able to be in a position to put kids through private school if we wanted to do that. Yeah. Be in a position where we don't have a mortgage. But also sort of more opaque ones where it's not have all of our wealth tied up in our property. How can we ensure that we have free cash flow from investments that are meaningful from other asset classes? So sort of those things that didn't have numbers to them, but were more in 10, 15 years, how do we want the life set up to be? Okay. A lot of things that we talk about on the show.
So Matt, that was the big lofty goals that Bryce had. Buy a farm.
Which he said no timing on. So I've got years to worry about that.
When you're that 91-year-old client.
Yeah, exactly.
Yeah.
I'm happy with that. The focus was really the focus was the mortgage, and I went in very specific as well, having learned all that stuff about debt recycling and tax. So it was tell me how we need to do this.
Yeah.
So then what's your process from there? How have you worked with Bryce and Harriet since then?
Yeah, so with Bryce and Harriet, we just had that initial meeting. So we always do that free of obligation, free of cost, just so people have a chance to meet me or any of our advisors and make sure we're a fit. From there, Bryce basically said, hey, we're happy to go ahead with you. It took a bit of time. I think you'd been seeing some other advisors or just sort of trying things out, came back, said, yep, let's go ahead. So from there, we kicked into the data collection mode. So getting a really good idea of what things look like for you currently and the current strategy. And we modeled that all out to say, under these assumptions, if you keep doing what you're doing, this is what it's going to look like. But then there was a lot of back and forth for a good few weeks there about, hey, Bryce, this is what I'm thinking and this is why. And Bryce coming back and saying, yeah, sounds good. Or, why are you doing it this way or that way? Or could we do it this way? And just a lot of dialogue, making sure he understood the strategy and was comfortable with that. That then all culminates in a strategy meeting where we ran through the strategy and then formalize it in a statement of advice, which I think Bryce has mentioned before on the show, but a 51-page document.
Nice.
58,
wasn't it? Anyway, whatever.
I'm going to trust Matt on this. But
I think it was 51, but maybe I didn't include an appendix or something.
Yeah. So Bryce is known for his diligent love of spreadsheets and tracking every cent. In terms of clients, and the difficulty of data collection, was Bryce the easiest client you've ever worked with?
Yes, actually. It genuinely was. Bryce sent me his whole budget. It was like a full spreadsheet. It broke it down into, where every dollar is going, all these different buckets, definitely practicing what you preach from a budgeting perspective. That made it really easy for modeling cash flow. I meet with clients and I say, okay, what are you spending? What are you saving? And they're just like, no, I don't know.
Yeah.
And it's like, all right, well, that's back to square one. Then we have to figure that out before we know what we can do.
So Bryce one time told me that he doesn't have an inch of fat in his budget, that he didn't have anything that he could cut out. Do you agree? Now that you've looked at his numbers,
I wasn't going to Matt to ask for budget advice.
No, look.
Do you think that was a fair comment from him?
Yeah, look, there's money that's allocated to like investing and saving, and you could argue that that could be changed, that's adjustable, but that's what Bryce was comfortable with and what he wanted to invest and save. And so, like I said, it was down to the dollar. Bryce didn't come to me for budgeting advice. I think my recommendation around your budgeting was, you nailed it, keep it up, or with a minor tweak, using offset accounts more where you can, and you had restrictions around your bank and multiple offsets from memory, so that was a little bit challenging. But yeah, the reason why I had Bryce's budget was to model out cash flow. So, with a reasonably sized mortgage, cash flow is tight for anyone really. And so we basically had to figure out a way to, okay, years that you have a deficit in your cash flow, how do we turn that so it's positive? And we managed to get down from, quite a few cash flow deficit years to cash flow positive years by structuring things a little bit differently.
I think that was the biggest thing for me going through the initial process, was seeing this is what your life's going to look like if you don't do anything. Yeah. This is what your life is going to look like if you restructure things in a different way. And not to say that this is what your life's going to look like is going to be shit, but it's just like with a few tweaks, particularly around tax and how you're investing, it does, like the compounding nature of it makes a significant difference. Yeah.
Look, just to add to that, without going too into the numbers, because this is all the modeling we do is based on assumptions. And I think I drilled that into you, Bryce, that, anytime you're saying...
Because it looks great on paper.
Exactly. But,
10% growth, 10% a year growth every year.
Wow,
exactly.
That's unbelievable.
Yeah, you got to plug in things like that where you're assuming, say, 10% growth, or the property market's going to do 5% or 7%. You're just taking guesses, basically. But if you can keep those assumptions the same between every model that you do, then what modeling does is it shows the benefits of the strategy compared to your current strategy under the same assumptions, right? So look, under the assumptions that we had in there, your current strategy, really good, done a fantastic job to get to where you are now, but we modeled out 12 years, really anything beyond 10 years is just becoming so inaccurate. But based on the modeling, your net worth came out $420,000 greater, and you saved an extra $80,000 of tax along the way. And that went from, like I said before, mostly negative cash flow years, and you had ways to cope with that, but cutting those negative cash flow years in half.
And that was with a paid off mortgage?
With close to a paid off mortgage at the end.
Yeah. That was getting to I think with a bit still in the offset, and it would have actually offset almost the total amount that was still left on the mortgage.
Yeah,
Wow.
yeah.
Okay.
Yeah. So that on paper it looks great.
So we should say equitymates.com/advice if you want to speak to Matt.
Yes, absolutely. He'll figure it out. But I should say, so that's kind of the strategy. To be fair, we haven't actually acted on a lot of the big stuff, which was restructuring how Harriet and I are investing and all of that, because we're still working through a few things. What we have acted on, and we want to go into detail today, is our superannuation. For Harriet, she wanted to be more involved with her super. She was just with an industry retail super fund. She wanted to be more involved, and she felt like she was a little bit behind on where she should be. And similarly, I am pretty involved with my super fund, but obviously just wanted to roll it all up into now what is Hub 24, and I guess manage it alongside you. So that's where we're at. We've both rolled over.
So let me just ask you here, are you and Harriet now, do you have the same super? Like, do you have the same investments?
No.
Okay, so
No.
because you've got a portfolio here, this is your portfolio.
This is my portfolio, yeah.
What's
yeah.
ham? Just 100% Bitcoin.
Harriet's very similar with, so for correct me if I'm wrong, for two things, and we'll get to it in a minute. She's not as geared as I am, even though I'd like to be more geared, but that's that's Matt's. She's not as geared as I am. And secondly, for some of the individual stocks, there are differences as well, so that as a household unit, we're diversified. Yeah. Is that fair?
Yeah. So we take a few different approaches when we're investing for a couple at Northhaven. So for a lot of clients, we'll be fully active direct equities, right? So Bryce, I know, has a lot of history with the index and is happy to hold the index as well. So we have an allocation there, but that's not common across all of our clients. Bryce certainly isn't the only one. It's very case by case, right? So our portfolios for our clients are fully bespoke. We get to know you, your risk tolerance, and the kinds of investments you like, and we build it around that. For clients that we have fully direct or mostly direct and just some managed funds, if they're say a husband and a wife, or just a couple in general, basically all of those direct holdings are going to look different. And it's because we're looking at them as a household and we're trying to diversify as much as we can across the household. With Bryce and Harriet, there's commonalities. Some of the, they both got the index in there, both got similar managed funds, but the direct stuff is all different.
All right, well, let's get into it. Don't hold us in suspense any longer. What's the portfolio?
So let's start with portfolio construction from an asset class point of view. So we've currently got cash and fixed interest at 5%, property and infrastructure at 10%, and then growth at 85%. Now, this was after a bit of back and forth with Matt, because originally I think you pitched closer to a 70-30 split.
Oh, Bryce was never going to go for
that. No,
that.
and I was hating that. So then I went back and said, I want 95-5.
Okay.
Well, I actually said, I think I said I want all growth. I was like, I don't understand why I understand why. I was like, I don't want cash. Yeah. None of that. Get rid of all of it. 100% equities.
So what was the argument to have 5% cash?
Well, there's a few reasons for cash. We're trying to build a well-rounded, diversified portfolio. In the wise words of Charlie Viola, we're not looking to blow up anyone's money, right? And it's all risk adjusted. So Bryce and Harry both did risk tolerance questionnaires and things like that. That gives us an idea of where you sit on that risk scale. Bryce came out as an aggressive investor, so right at the sort of upper end of the spectrum.
Not surprising.
Yeah. So and look, it's appropriate for someone in Bryce's position and his age, and that was fine. So we have our standard asset allocation for such a client, and that would look like more sort of 10% cash and fixed interest, 15% property and infrastructure, and we consider property and infrastructure part growth because they're still equities, they're still shares in companies, but also part defensive because they have some quite defensive attributes, and then the remaining 75% across Australian and international equities. Bryce came back and he wanted a whole lot more in equities. We settled somewhere in the middle. The reason for having this 5% now to cash and fixed interest, firstly, you have to have some cash in these accounts because there's fees. Any super fund that you're with is going to keep a little bit in cash because they need to take their fees just like Hub 24 does. So there's a minimum amount of cash you have to have in there. But on top of that, we've added some exposure to bonds and other fixed income assets. The reason being, they're good ammunition when you need it. It's easier to get out of a lot of these assets without tax liabilities. So if you see opportunities in equities, you have some ammunition that you can draw on to buy into the equity market. Also, just the negative correlation with equities. So it's a bit of a hedge, a bit of protection against what equities do. That doesn't always work. So 2022 was the worst year. 2022 was the worst year in history for bonds in a couple of 100 years. And equities had a pretty tough year as well. So sometimes they do move together, but that was quite unique with yield spiking and the impact that had on bonds. But generally, there's a negative correlation. So if equities are pulling back, then your bonds or your fixed income is hopefully holding things together for you.
So I let Matt have his fun in the 5% fixed interest. So just to break it down, there's 5 positions within this part of the portfolio. Cash at 1.5%, and then everything else is about 1%. So we've got a Global X Treasury bond, a Metrics Direct Income Fund, an Australian Composite Bond ETF, and an investment grade corporate bond ETF. I have told Matt that his benchmark for the 12 months is DHHF. So
across the whole portfolio.
Across the whole portfolio.
Okay, yeah.
So for the end of 12 months,
Not
I don't think I've told you that actually, but GHHF, we'll go the geared.
All right, that's a challenge.
So that's fixed in. Then 10% is in property and infrastructure. So we've got the Vanguard Australian Property Securities ETF. We've got the Vanguard Global Infrastructure ETF, Transurban, Auckland International Airport, APA Group, and Region RE. The direct exposures there are all about 1%. The ETFs are between 3 and 3.5%, which gives us that 10. What was your thinking around this, Matt?
Yeah, so look, property and infrastructure, like I said before, part growth, part defensive. So it's growth because they are shares in a company. Also part defensive just in the way they operate. So they're seen as a bit of a bond proxy. So in previous years, bonds have been a little bit out of favor with yields going higher. Property and infrastructure assets are valued in a similar way, so they've been a little bit out of favor. But as yields start coming down, we expect these to start picking up again. The reason why they are quite defensive is a number of reasons, often very high yields. So APA Group in your portfolio has a yield of about 7 to 8%. And so it's generally pretty stable income. It's lower volatility due to these long contracts they have, often with government bodies. It's an inflation hedge. So Transurban, also in your portfolio, they own and operate toll roads. Most of us would have paid Transurban a few tolls. They have a lot of their revenue linked to inflation, so they can just keep bumping up their prices with inflation with a floor of 4% on some of their revenue. So regardless of what CPI does, they're just passing on all these inflationary costs. So very defensive in that sense, as well as these are essential services, right? So APA Group has gas pipelines all throughout Australia. Auckland International Airport is the largest travel hub in New Zealand. Transurban, toll roads. VAP has a large exposure to Goodman Group, so these big industrial sites and data centers. They are going to function well in any economic climate because they're essential services. So it's got that defensive aspect. So that's why that's in there.
So with these particular shares, Transurban, Auckland International, and the like, how are you thinking about like holding times for them? Do you think about some of these like longer term bond proxy stocks the same as some of these ETFs and funds?
Not necessarily. So these are all fairly opportunistic buys based on what the price has done recently. So as I said, they've been a bit out of favor with yields higher. We expect that to turn. We, perhaps would have been more flexible around the asset allocation in previous years, just given what they were doing when they were at highs and weren't looking as attractive. But now it might take a year, it might take 2 or 3 years to play out, but we think now's a good time to be in there. So it's more opportunistic.
Nice.
All right, so then the growth part of the portfolio, which is 85% of the portfolio, and this is where I was knowing, having had experience with a lot of the core index ETFs, I wasn't keen or didn't see the need to have everything in just direct stocks. So to break that down, my Australian exposure is between 2. We've got the A200 and the Gear portfolio ETFs. US, we've got IVV and the geared GGUS. We've got Europe, VEU. Then we go into a bunch of managed funds. So we've got Munro's Global Growth and Hyperion's Australian Growth. On the small cap side, we've got Munro's Small and Mid Fund. And then for emerging markets, we've got Pengana Emerging Companies, Spheria Emerging Companies, and the Plato Global Alpha Fund. So that kind of makes up the core. Then we go into some thematic ETFs. We've got Semi, Hack, and Robo, all of which I think would be very well known amongst the Equity Mates community. We also have in there a Banks ETF. And I think that's it for ETFs. And then we go into a bunch of individual stocks. So we've got Gold, Newmont, we've got James Hardie, Google, Microsoft, Block, Lockheed Martin, Disney, Transmedics, Chipotle, and Costco. Now, I read it in kind of weighting order. So the most weighting is up in the index, with most of the individual stocks not going over 1.2 to 1.5% of the portfolio. I think just to put some context to how this is different to my original super portfolio, I didn't have any individual stocks in my original super portfolio. I just had a shitload of of American tech and gearing, which was doing well.
It was.
As much as I could get because it was limited in Superhero. And I didn't have any of the managed funds. I know Ren was keen on some of those managed funds, so that was good to see. And I did have some of those thematics. I had Semi and things like Fang Plus and bits and pieces. The biggest change here is obviously a much more structured portfolio construction, because I didn't have that sort of lens on it, and many, many more positions.
Now, Bryce, when you read through that list, one thing I did think was not a lot of specific Asian exposure. I'm sure there's some in the managed funds. But VEU, you mentioned, it's not just Europe, it's all world ex-US. So it's Europe and Asia.
Yes.
Correct.
Yes.
Yep.
So that's kind of your core, America, Australia, and then VEU is kind of rest of the world ex-US.
Yeah.
And then everything else is your satellite.
Yeah.
Is that? Yeah.
Yes. Yeah.
That's it. Yep.
So one question I wanted to, briefly discuss, Matt, because it could go down a rabbit hole, but was just around your process for manager selection, because we've got a number of managers in here, of which Alec and I are aware of and fans of. But if you were to put this in front of someone who had no idea, how do you go about selecting Munro, Hyperion, Pengana? What's your thinking?
Well, actually, sorry. Before you even answer that question, because when Bryce was reading that list, I clocked that these are a lot of managers we've had on the show and that we think do a good job. Did you have any input on the managers?
No.
So this was all Matt. Yeah. Okay, that's interesting.
Yeah.
So it means we have somewhat of good judgment of people that come through.
Yeah, I did read. I did look
If
at
you trust
this
our
when he put it
judgment.
through, and I was, I was like, you know what, we're on the right track.
Okay. So to that question, how do you end up with these managers?
Yeah, so these managers, this has been years of meeting with fund managers. So even straight after this, we're going to meeting with some fund managers. So getting to know them, seeing them present, having that more personal level, so they're not just a name behind a screen. It's also been years of the guys at Northhaven, our investment committee, researching these particular fund managers. That means looking at fees, looking at performance, just checking that their whole investment philosophy aligns with ours. And these are the names that we've come across over and over again that have sort of pointed to these are some of the best in the business. They outperform and we like their style. And that's what it comes down to. So a lot of our clients will hold these similar fund managers because we really back them.
So similar question from me around that I asked earlier around the individual stocks. There's a list of names there: Aussie stocks, US stocks, some big, some nothing too small, some sort of medium size, I guess you'd say. How active do you plan to be in this individual stock part of the portfolio?
Yeah, fairly active. Again, this is all opportunistic buying. We've seen these at what we consider either good prices, or admittedly some of them are expensive, but it's because we see good future, good growth for a lot of these names. But we don't buy and hold forever. So we are long with our equities, but we take profits, we trim and we reallocate that. Part of that is keeping this asset allocation in place as part of good portfolio management, making sure we keep that structure. But also we just don't want to let something run forever when an opportunity is presenting itself elsewhere.
And so is that you're doing that work, or is there an investment committee and like model portfolios in the background, or are you
no, none of that.
Prices super all the time?
Yes, yeah. So for all of my clients who I'm managing money for, I'm actively watching this, keeping up to date with what each company is doing, and taking a very active approach. Now, we're not equity analysts or anything like that. You know, we do rely on various sources of information and news to understand these companies and financial reports and so forth. But we might not be equity analysts, but we certainly back ourselves as portfolio managers, and we have a long history of doing that. So yeah, active in this space, but I wouldn't make a substantial change without talking to Bryce first, right? So this is all run under a managed discretionary account, which means I can actually do basically anything I want with this. Bryce has signed off and said, manage it as you see fit.
Yeah.
But
That won't happen.
But Bryce can leave you at any time. So
he can. He's not locked in forever.
Yeah,
when he wants to go elsewhere, he can. You better not, but he can. So, yeah, but any significant change, I would be on the phone with Bryce and say, this is what I'm thinking. This is why I'm thinking it. Should we make this change? What are your thoughts? Or do you see opportunities elsewhere? So he has a lot of input and flexibility around this as well.
Maybe,
I
maybe
think
don't ask him what he sees.
I mean, James Hardy's a good example. When the news came out and the stock plunged 20%, Matt was on the phone. Don't panic. This is why, kind of thing. This is our thoughts. What do you want to do? Kind of thing. So I think just to sort of close it out, the strategy going forward. Obviously, there's going to be regular contributions. We can't split it, or we won't be splitting it amongst every single position in the portfolio every time the money goes in. So we'll kind of weight it towards the core, have a bit of cash on the side so that when opportunities come up for me on the show, or I want to be active, or if Matt and the team find that there's changes that need to be made, we'll have some dry powder on the side as well. And that it'll just be an ongoing process now.
Yeah.
Love it. Well, that was really interesting. I think it'll be interesting to keep tracking your journey, Matt. I think Alice and I will probably come and chat to you soon, so we can have a similar conversation. But if you want to speak to Matt or any of our handpicked advisors here at Equity Mates, head to equitymates.com/advice. Fill out the form. Let us know a little bit about who you are, and we'll match you with an advisor that we think fits your circumstances and your needs. Or if you just want to speak to Matt and you want to skip most of the form, there's a drop down where you can choose Matt or anyone's name, and we'll just put you in touch directly. But Matt, thank you for dealing with Bryce. I'm sure that wasn't easy.
No, it's been a pleasure. Yeah,
thank you for agreeing to come on the show and chat through it.
Thank you so much. It's been great.
Thanks, Matt.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.